Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, May 27th, 2016. This week, S&P 500 ETF SPY with dividends hit all-time closing high, while the index itself, S&P 500, still fell short of the all-time highs. The market breadth did improve further. We will compare 1973 versus what it looks like today, because I think the picture is somewhat similar. Bonds should be dropping from here, but they're not. We'll see why that is happening. Of course, the dollar rally and dollars weighing on commodities of all sorts, gold in particular. While inflation is tame, we'll look at some of the historical examples. Oil hit $50, and we'll also look at natural gas. Okay, so this is S&P 500 ETF SPY. This is a all-time closing high, I believe, at 210.24. Now remember, this is S&P 500 ETF SPY, which has dividends added into it. So the price itself, the price actually has the dividends added into it. In other words, we'll look at when we get to the actual index. I'll show that it has not yet hit an all-time high. This is quite a powerful rally off of February lows, and actually it is also an unprecedented rally. I think I believe like this happened once in 120 years or something like this after a drop like this. So we're sort of in uncharted territory, and I'm not sure exactly why, but most likely it's happening because of the constant interference from central banks from around the world. Further down below, we have several breadth indicators and volume indicators. On balance, volume still hasn't hit all-time high. We can see it hasn't broken out. Advanced decline line did break out. I pointed this out a while ago, while the advanced decline volume line did not break out. So you can see that the volume is still lacking on this advance. There's this breadth momentum oscillator. I kind of like this oscillator, and it's sort of an oscillator of the advanced decline line. And looks like we were dropping, but we kind of held support here around the zero line. So this is an oscillator. Eventually, it will oscillate into the negative territory. We haven't done that yet. Don't exactly know when it's going to happen, but it's possible. This chart shows the actual S&P 500 index, SPX. And you can see that we have not hit an all-time high without the dividends. Up here we have my proprietary market breadth index, and you can see that it improved further. Now it's at 4, and I'll actually go into more details in follow-up slides. But on this chart, I want to show the percentage of stocks above the 20-day exponential moving average. I pointed out that last week that it went below 40, but it's sort of like a short-term oversold condition, and we got a bounce. We had something similar here in November. You can see we went below 40, and then we got a bounce. But eventually we did roll over. Now, situation here is somewhat different than here because the breadth has improved. You can see it's now at 4. Used to be here at 1. So we're certainly getting to the point of where I say that most likely we're going to push above 5, and that would be a entry back into the bull market, and then I will be looking for long opportunities. And I am not really married to going long or short. With stocks, it's actually easier to go long because there is an inherent bullish bias to the stock market. So if when we get above the this 5, I have no problem going long and going and buying stocks. All right, this is a weekly chart of S&P 500. So each of the sticks here, each of the candles is 1 week's worth of activity. You can see this was a very strong week here. We had about over 2% gain, and we're coming very close to this trend line that I drew in from the highs that's touching the recent peaks. Now, it's entirely possible that we break out above this level and just continue higher. So far, we haven't done that. and we'll see if we do that. And if we do break out again, most likely we're going to get a pretty strong move, because this has been a very long-term consolidation going back to 2014, I guess. So yeah, we could break out and just continue higher. Alternative scenario, of course, is we're gonna just turn around and fall out of bed here. This is a similar chart, but with S&P 500 only the closing prices. So we have the 52-week closing low here just this year. These are trend lines that I drew in from the tops of the closing prices, and you can see that we actually broke out above these two trend lines, and now I redrew this trend line to the Friday's close. Again, it's possible we're gonna break out and continue higher. Also, it is also possible that we're gonna get a rollover like this and a retest of this February lows. This is a broader New York Stock Exchange Composite Index, which includes a lot of small cap stocks. Pretty similar picture. I wanted to show this breadth momentum oscillator. Again, we have been in a positive territory, and we have not yet rolled over into negative territory. And in the past, when we rolled over into negative territory, we could make a pretty nasty looking drops. So anything is possible. We could again break out and continue higher. Now there is quite a bit of resistance here. You can see that it touched it twice around 1070 or so, 1059. Looks like we may be headed for a retest of that level again. So we'll be watching if this resistance will be reaffirmed, or alternatively we could break out above this resistance level and continue higher. Further down below, we have breadth indicators, and we are making more new highs than new lows. In other words, new highs are outnumbering new lows. But as I showed the same thing for S&P 500, I'm still not seeing a breakout in volume or a breakout in advanced decline volume. We did get a breakout in the advanced decline issues, so that's a positive thing for sure. Similar to S&P 500, we had a drop for the percentage of stocks above the 20-day exponential moving average into the below 40 territory, and then a bounce. So it was like a short-term oversold condition. Whether or not we're going to get more weakness or more strength is hard to tell. It's really difficult to say at this point. We'll just need to watch this resistance level, and if it is reaffirmed, then we could easily drop down to retest the February levels here. This is a S&P 500 going back to 1996. I removed the price and I left the 50-day and 200-day moving average in place rather. Up here we have market breadth index as my proprietary index. Now, what this index does is that it looks for entries of the S&P 500 into the bear market or the bull market. And this is a very long-term chart. This is going back to 1996. And you can see it called the bearish and bullish markets pretty well here. As of 2015, the middle, I believe October of 2015, it was calling a bear market. But we're now back at this level at 4, and one of the inputs for this index is actually coming back to 71. So we are improving significantly in market breadth. So it's possible that this bear market may be already over and we could just break out to new highs. However, again, there is still a possibility we could just roll over and continue lower. So this is a more zoomed in version of the same chart. You can see that we are approaching, well, all-time highs were back here, but we are improving in this indicator. So the market breadth certainly has improved over the past few months. again, this raw MBI is one of the inputs for the market breadth index, also has improved, and we are really approaching a bull market territory. Now, I thought I would look at some of the historical examples of the bear markets, actually, as was called by market breadth index, and I looked at one of the examples, and I found one in 1973 where we did enter a bear market here in July of 1973, and then we had a strong rebound, kind of similar to what we're having right now. In fact, also the market breadth index came back to 4, and it was a a strong rally. And then wanted to see what happened afterwards. So let's fast forward um, a few days and see what happened. So you can see that going forward, after we hit this high reading of 4, we basically fell out of bed and continued lower afterwards. In fact, we were making lower lows. Now, the only difference that I see from the current picture to what we have here in 1973 is that one of the inputs for this index, the raw MBI, was at relatively low levels. It was only around 50. While right now, let me just go back, we have raw MBI at 71. So again, it's possible that we're just going to push to all-time highs, and this will improve even more, even more. Excuse me. But versus the 1973, we have to keep an open mind that sometimes a high readings in market breadth index will indeed roll over and continue lower. So after this, we had a bear market for a while still, until let me just see when it finally became a bull market. When it bottomed out in sometime in 1975, I believe. Yeah. So and then market breadth index did hit a bullish market territory. So keeping an open mind, high readings in improved breadth is possibly a good sign, and it definitely is a good sign rather, but it is possible that we roll over and still make another lower low from here. Another piece of the puzzle for the current market posture is the transportation index, trend, $trend. Pretty obvious downtrend that started back in 2014. Actually, this is a peak here in 2014, and we're pretty obvious downtrend, and actually we're coming sort of to resistance levels here. Now, if you subscribe to the Dow Theory, then we need to have transportation index also attempt to break out to all-time highs, and they're pretty far off from the all-time highs. If S&P 500 breaks out but trend doesn't, the Dow Theory will not be confirmed. So that's just another piece in the puzzle. I wanted to mention Chris Chilako, and this is an article on his blog here, short text. Actually, he's a really good analyst. I highly recommend you watch his videos. So what does the history say about markets that failed to new highs for over a year, and that there is a 77% probability that we still roll over into a bear market, and this is based on 13 instances going back to 1946. So there is still a significant probability that we can roll over into a bear market and make lower lows from here. In other words, we should keep an open mind about not only bullish outcomes, but possibly about a bearish outcome as well. Okay, so if we say that S&P 500 is breaking out to all-time highs, my question is, why are bonds really not behaving that poorly? Bonds are usually assets that are bought during risk aversion periods, but in this case we're seeing bonds really close, trading to all-time highs, just as S&P 500. I mean, we did get a drop here the week before when Janet Yellen announced that they will be raising interest rates, but this drop was really not that significant. So I guess there's still quite a bit of fear in the markets, and this is reflective of that fact. So this is TLT weekly chart. Again, we're close to all-time highs, and this week's basically S&P 500 gained over 2%, while bonds lost less than a quarter of a percent. So sometimes this makes me wonder, maybe TLT and maybe bonds are kind of coiling up before a breakout to all-time highs. And again, I showed this before. This is a possible cup and handle pattern. Maybe we're getting this handle rather, and we can just break out to all-time highs. This is a huge cup and handle. So we could get an enormous move up for TLT, and conversely, we could get a very large move down for stocks because of the fear in the markets. Especially AGG, which are more diversified bonds, they're actually gained this week. I'll show next chart. So you can see there's a little gap here, and this gap was maintained. So kind of, here is that TLT weekly chart. So you can see that it actually gained this week, and volume is also showing positive bullish patterns, and these are all-time highs here. So again, I wonder why bonds are really not showing signs of selling that much when stocks are possibly breaking out to all-time highs. The only place I could find some significant selling was in the municipal bond universe. We did get, this is an all-time high, so we had a kind of bearish engulfing here, confirmed bearish engulfing, and a follow-through lower. So now we're sort of at the possible support here from this peak. But in any case, this is a very bullish chart, so we had a very nice move. For my subscribers, we're locking in some nice gains here, both from dividends and also from the actual capital appreciation for this fund. So if bonds correct more, I will be looking to re-enter or add to position further on. So the dollar had a really nice big move from this low in May. This was clearly a bear trap. We had a support break and an immediate move back from below the support. Euro it really weakened against most, two major currencies against euro, or rather strengthened against euro and against the yen. Kind of traded flat against a British pound, but remember that Britain is going to be voting for whether or not it will remain in the European Union. So Brexit vote is actually very soon, in just a couple of weeks, and in 3 weeks here, on June 23rd. So this will absolutely, certainly send shockwaves throughout the currency universe. Whether or not it will be an exit vote or they will remain in the Union, one way or the other, there will be repercussions in the currency universe. So as of right now, I see pretty bullish pattern for the dollar, and this bullish pattern is a weekly chart going back to 2014. Very large breakout, and then a correction or a consolidation sideways. So if we get a breakout above the about 100 level here, we could easily see a strong move of around 9%. Or possibly more. This is just the depth of this pattern. Of course, by extension, most likely euro will weaken strongly, and possibly it will weaken. The yen will also weaken against the dollar. Okay, so since the dollar is strengthening, and it makes sense to talk about gold, because gold and dollar move pretty much in the opposite directions, and yellow here is gold while green is the dollar, and you can see that it has a strongly negative correlation to one another. It's not always strongly negative, especially here back in the 70s and 80s, and I think the reason for that is back then we truly had some inflation. In fact, what I did here is I put in consumer price index and I put a rate of change on it on the indicator. So we had a pretty strong inflation here in the 70s and 80s, approaching, let me see, what is it, like 10-12% a year. And even though the dollar was kind of trading sideways, we had strong inflation and gold gained at that time. But then Paul Walker came in and into the office and raised the interest rates significantly, and the inflation came under control, and the dollar obviously rallied as well. You can see that gold peaked out here and then just collapsed from there. So currently we have somewhat of a interesting picture as well, because like I just showed, it's possible that the dollar will break out and continue higher. If the dollar breaks out and continues higher, gold will come under serious selling pressure. And the reason for that is because right now we have pretty much no inflation. In fact, recently we had a deflationary period here in 2008, 2009. And right now inflation is very tame. So there's not that many reasons for gold to be appreciating against the US dollar. I'm sure if you live in Venezuela or some other country where there's lots of inflation, that the gold is appreciating tremendously in price. But against the US dollar, there's no really inflation to talk about in the United States. Especially now that they're talking about raising interest rates, this will further potentially decrease inflationary pressures. So it's possible that this gold has potentially broken out to the beginning a new bull market. But if the dollar pushes higher, this whole entire gold bull market, new bull market on gold will come under question. So next couple of charts I'll show what I mean. Okay, this is the price of gold, spot price daily. So we had a clear breakout here back in February of this year, because it's a breakout above this level here, and then continuation higher to 52-week highs. Now you can see that gold has been under severe pressure, especially the last couple of 6 trading sessions, just non-stop selling. 1, 2, 3, 4, 5, 6, eight trading sessions, almost 2 weeks. We had pretty much non-stop selling. So it appears that gold is going to be retesting this breakout, and it's coming back down to the $1190, $1,200 area. Now the volume here, this is a very large volume on this candlestick. It could mean that we're sort of approaching a selling climax, and maybe gold will stabilize and bounce. But it will again depend on the dollar, and if the dollar, weakens a little bit. Let me just go back to the dollar. It has a pretty strong rally here in the dollar, so the dollar really needs to weaken quite significantly for gold to attempt to at least rebound higher. This is a weekly chart of gold, and it's more clear sometimes here. Sometimes it actually makes sense to zoom out quite a bit and take a look at the at the longer term chart, and maybe weekly chart sometimes it's more helpful. So you can clearly see this level here at 1190, 1200. Several important touches, a breakout here and a touch here in March. It looks like we're basically there. So this volume is high. relatively speaking. So maybe we maybe we bottom out here and bounce higher. Again, it will really depend on the dollar. As far as GDX, the gold miners, it's a lot more volatile. This is over 100% move, so no matter how you slice it, this is a very overbought condition here, so we are kind of in the process of correcting. And this week, on Friday, we did close below the 50-day moving average, so this is a significant achievement for, I guess, bears. But even the shallow correction from the all-time high to this 52-week, from all-time low to the 52-week high, should take GDX back to around 2089. So looks like we have still some correcting to do. Even deeper correction will take it to around $19 and possibly even to around $17.60. Now, if we break down below $17, we could, as I said before, we could question the entire new bull market in gold. Market breadth, not much to show here. It looks no divergence that I'm able to see. Continuing in the commodities universe, this is West Texas Intermediate, light crude oil. Again, a strong rally off the February lows. We're approaching the $50. We actually hit $50 intra-week here. Maybe we'll bounce a little higher. I mean, there is some resistance up here around 54 or so, $53. There's quite a bit of resistance here. I still think this is a bearish chart. So where we will run into resistance is hard to say. But looks like we're already getting into the overbought territory. You can see this money flow index. When we tapped out here around 80, we did roll over. So it's possible we're already getting there. A more clear looking chart is USO, and this is a weekly chart. Again, it's not a very good investment vehicle, but it is okay for trading. And pretty clear looking rising wedge that is, again, basically at resistance. There is resistance here from this gap below this level. So a turner, some kind of a bearish engulfing maybe here would be a good, maybe possibly a good signal to go short. I mean, here we did roll over, and then we took a while to roll over before a really, severe breakdown happened. So it's possible we'll get something along the same lines. This is UNG, United States Natural Gas Fund, a very choppy commodities. So if you trade it, be even more careful than normally. Size your positions appropriately. UNG itself, I think, is not a very good trading vehicle, just like USO. Not a very good investment vehicle, just like USO, because there was a slippage. But for trading, it's okay. And this is a weekly chart. We possibly are getting a rising wedge break from this formation here, I guess. And if we get a rising wedge break, and if this is indeed a rising wedge break, we could easily retest the lows we set in February and possibly continue even lower. Alternative scenario is always possible. We could, rally back up, and there is resistance here now at around, what is it, 750, 740 or so, and possibly even higher around 850. But this, for now, looks to me like a rising wedge break, and it's possible we're going to get a new lows here in natural gas. That's it for this week's recap. Thanks for watching. Have a great week. Please stay tuned on how to find us on the internet. Thanks a lot. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing. You get 3 weeks free trial, and it's only $24.95 per month thereafter. You get access to my charts, exactly what I'm buying, exactly what I'm selling. I have an internal blog. Also, I have several videos that have to do with trading and various aspects of um, risk control, as well as just the psychology of trading. So please do consider signing up. The subscribers are getting really good results, I think, and I'm getting some very good feedback. I have a performance section here where I post the actual portfolio percentage change. The inception date was in 2015 October, so it's not a lot of history yet. And there's some backtesting results that I feature here as well. The blog, of course, is where you'll get this information, and there's a video section where I separate them out for easier access. Click on the social page, and here we have a link to public charts page where most of the charts that you're seeing in this video are going to appear. If you have Twitter, Facebook, YouTube, StockTwits accounts, you can find us there as well. If you subscribe to our mailing list, you'll get a special price for our trade alert services. That's it for watching. Thanks for watching, and have another great trading week. Bye bye.